All right, I want to get moving with the introduction. So a little backstory here. I met Mel here in Tucson, Arizona. And when I first moved to Tucson, I thought it would be good that I get get my hands into a business networking group in order to, build my practice here in Tucson. Um, and Mel happened to be visiting the chapter that I was visiting on the same day. So we introduced ourselves and told her I was a massage therapist. And then Mel said to me, she's like, "Oh yeah," she's like, "My godmother wrote a book for massage therapy." And I have a lot of history in the massage education world, so I cannot tell you how many people actually tell me this exact phrase, like, "Oh, somebody I know wrote a book, somebody I know has a thing," right? So I was like, "Yeah, yeah, yeah." I was like, "Okay, what's the book's name? What's the title of the book?" And she says, "Business Mastery." I'm like, "Cherie Sonnen Mo is your godmother?" Because I've worked with Cherie in a school setting for so long. So it was, you know, friendship at first sight, and then having this connection to Mel, and then having an advocate for someone in our industry who knows the industry, who knows about the struggles of you know uh what's the word I'm looking for? Just an income that's not steady. What am I talking about? How come I
Irregular.
irregular? I don't know why I was stuck on that. Thank you, Mel.
I
A
got you.
regular income, things like the pandemic that come up, and we have some financial challenges with that. And for those of us who have been doing this for how long we've been doing it, how to really make the most of those dollars. So Mel is a financial planner. She owns a women-owned financial planning company. I'll give her the platform to tell you a little bit more of her background, but know that we are in good hands from somebody who really understands our industry. So Mel from Bloom Wealth Alliance, welcome and thank you for your time.
Aw, thank you, Adrian. So hi everyone, really happy to be here. As Adrian mentioned, yes, Cherie Sonenmo is my godmama. She helped raise me. I worked at Sonenmo Associates as a young teen and through college. I think my name is in a few of the Business Mastery editions. So I grew up in the massage world, and actually, this organization is near and dear to me. MTF was an organization that I spent a lot of time around and have throughout my entire teen, especially, and adult life. So that's a little bit about my background and my association with the bodywork industry. As for BWA, I have my own investment advisory practice. I specialize in working with women, although I do work with couples and things of that nature, but working with women is really my passion, and education surrounding finances and financial planning and retirement to make sure that women are on track and be able to have the best version of next chapters in their lives once they are able to work on their own terms, which is what I consider the new retirement to be. So that's a little bit about me and what I do and my background. And tonight, very happy to be here to talk about charitable giving and planned giving strategies. And that's what I have been invited here to do. And I have a little PowerPoint presentation because unfortunately, some of the things that I'm talking about do involve taxes and tax strategies, and there's really no way to do that without some visuals. So if I can get a screen share, I will hopefully
You
take
you
it
have that
out.
access.
I have access? Okay. bear with me as I make the attempt here to get this presentation up. Oh, that's not the one.
While Mel was doing that, just a friendly reminder that our International Massage Therapy Research Conference is coming up in April. It's April 25th through the 27th in Arlington, Virginia, and we are super excited about the programming that's coming for MTRIC this year. We have a really great team working on the program, and it's going to be a lot of really cool information and updates about some of the stuff that we're doing. Hi, Rachel. Thanks for joining us.
Good Lord. Okay, hold on. Sorry, folks, I have two browsers open and I think that was confusing everything. My sincere apologies.
All good. All good.
Okay.
There we go.
There we go. All right.
Right. So okay, great. Great.
We are going to move this over. Add it. All right. We're going into. All right. Okay. Can you see it? All right. Wonderful. Thank you for your patience. Okay. So, as the Massage Therapy Foundation is a nonprofit, we want to talk about charitable giving and strategies about how to support nonprofits, foundations, things of that nature. So the power of charitable giving or planned giving is the art of supporting the organizations you love while also be able to be creating a lasting legacy. This is a transformative act that is testament to the power of both compassion and foresight. There is, however, a perception, and I hear this often in my line of work, that if someone doesn't have a significant amount of money, as in cold hard cash, they can't really engage in this type of giving. So tonight, I want to dispel those myths and talk about a few planned giving strategies that do not involve diving into bank accounts at all whatsoever. We're also going to talk about the financial and tax incentives that are on the table when we employ some of these strategies. Now, I know and I fully acknowledge that most people would rather chew glass than spend an evening talking about taxes and like higher level finances. So I am going to attempt to make this as entertaining as I possibly can and also as painless as possible. So before we do that, there are some important disclosures that I have to get out of the way because somewhere somebody on my compliance team is having heart palpitations as I'm going to be talking about taxes. So let it be known for legal purposes, I am not a tax advisor, and any strategies mentioned here are not an endorsement of any individual advice. And as always, please consult CPAs, EAs, or your own financial advisors before any consideration of any of the plan giving strategies we are going over tonight. Okay, compulsory, boring legalese out of the way.
It's like on our intake forms, we're like, we're not diagnosing you. Like yes. So we see the parallel. Thanks, Mel.
Yes, has to be done. Okay, so there are so many beneficial reasons for planned giving. We know that engaging in charitable giving, there's a profound sense of purpose and fulfillment, the social impact in building community. You get to support the organizations that you love and you care about. And if I haven't sold you on that idea yet, there is always the tax benefits and those financial incentives. And the thing that I love about all of this is that those things do not have to be mutually exclusive. So we're going to go over three main strategies that not a lot of people are aware of in order to achieve this. So let's dive in. And the first one, and probably one of the most powerful, is gifting stock. Low basis stock, to be more specific. Now, folks, basis is just a very fancy term for what you originally purchased something for. So when you gift low basis stock, this can offer several tax benefits for both the donor and the organization receiving the stock. If you give stock to a qualified charitable organization, like the MTF, you can claim a charitable contribution deduction for the fair market value. Fair market value is just a fancy term for saying what it's worth today at the time of the gift. So you can claim a deduction up to IRS limitations. So let's take a look at like a case study and how this play out. We're going to meet Crystal, and we're going to call her Crystal because she had a crystal ball, and she had the foresight to buy Microsoft back in 1986 at its initial public offering. Good for Crystal. It was worth $21 a share back then. And that is considered her basis, that $21 a share. So if Crystal has 1,000 shares of Microsoft back then, her purchase price was $21,000. Well, at the time that I put this presentation together, which is about a week or so ago, the fair market value was $459 a share. So Crystal's fair market value for those shares is $459,000. Now, Crystal just recently got stuck in the Dallas-Fort Worth airport for 3 days because of that Microsoft shortage, and she wants nothing to do with that company anymore. Now, we don't blame her, but she would like to get rid of that stock, give it away, and gift it. Okay, well, fair market value is $559,000. Her basis is 21, which means Crystal's facing a capital gain of $438,000. Yikes. So what are Crystal's options? Well, she can sell her stock and pay that 23.8% capital gain, which is over $100,000, and then gift the rest. Or Crystal can gift her shares to the Massage Therapy Foundation. Now, here's the beautiful thing when that happens. Neither Crystal or the MTF pays any capital gain tax on that $459,000. Not only that, Crystal gets a big fat tax deduction, not on what she paid for them, on what they sell for today, up to 30% of her adjusted gross income. So if Crystal's AGI for the year is $150,000, she can deduct $45,000 for her charitable contribution. And let's say that Crystal doesn't need that whole $45,000 as a deduction for this year. That's fine. There's a 5-year carry forward on excess charitable contributions. So she can take $15,000 this year, $15,000 the next year, and so on, however she wants to use that. So this can be a really powerful way, gifting stock, to not only support an organization, but there's some serious tax benefits for the donors as well. Now, I fully acknowledge this is a pretty extreme example of like higher ticket stock, But this can also work if you have stock in your portfolio of a $2,000 gain. It's any amount. And it's a wonderful time and a good opportunity to talk to your advisors, let them know that you're charitably inclined, and to see if there is any opportunity in portfolios for this kind of gifting strategy, especially if you have portfolios that get rebalanced. This is a great time to look and see if gifting stock can be a possibility. So to recap, when you donate appreciated securities, securities that have gone up in value, to a qualified charity, it's the fair market value, what they're worth at the time of the gift, that gets deducted from your taxable income. Neither you or the charity will be taxed on the capital gain, and therefore, folks can make a bigger impact with your charitable donation by gifting the stocks instead of liquidating them and then gifting the cash after you've paid capital gains tax. So that is one strategy that's just good to know about that most people do not know. So moving on, one that everybody should know about.
One second, Mel. Just 1 second. I just want to let everybody know on this call and whoever watches it in a recording that the foundation is prepared to receive that kind of donation. Just so everybody knows, there will be no barrier from your interest to give and us graciously receiving it. Thank you.
I'm so sorry. I should have mentioned that from the beginning. Anything that we go over, the foundation is already set up to receive. Thank you for that clarification. Important to know. So one of the strategies that everybody should just be aware of in general, if you have an IRA, are the qualified charitable distributions. So anybody who has an IRA or is going to be in the position to inherit an IRA should be aware of this. And this is because of RMDs, required minimum distributions. So we're going to take a little bit of time to go over those. So required minimum distributions are the amount of money that the IRS and Uncle Sam says, once you hit a certain age, this is the amount that you have to take from your qualified retirement accounts. So we're going to do a little case study here. We get to meet Mary. Mary has an IRA, and how we calculate RMDs, you all get to learn how to do this tonight, is we take a look at the account balance as of December 31st of the previous year. So we need to find out what Mary's RMD is for 2024. Her account balance was $345,000 as of December 31st, 2023. Mary is 73 years old. There's actually a table that we use to do this. It's called the Uniform Life Expectancy Table. It is based on life expectancy. There's no other way to say that. And these are the actual numbers that are used. So we line up Mary's age with that table. That's the actual number. We take Mary's account balance. We divide by the number associated with her age in order to get Mary's required minimum distribution. So that'll be about $13,000 and some change. Now, Mary can take more than that out of her account, but she cannot take less unless she wants the IRS to come a knocking, because they're pretty particular about that. So that is $13,000 that is going to hit Mary's tax return. That will be included in her taxable income. So Mary can take that money, or Mary can make a qualified charitable distribution to the Massage Therapy Foundation instead. she routes that money directly to a qualified charitable organization, and that money never hits her tax return. So it does not count towards her taxable income. A charity can get a really lovely donation, and Mary doesn't add that $13,000 in. Now, some of you might be wondering, why on earth would anybody want to do that? Well, there are a few reasons. One, some folks just genuinely do not need that money and charitably inclined and want to direct funds to causes they're passionate about. And for other people, that money might not be a good idea for them to take. We have to be really conscientious about taxes in retirement for retirees for a number of reasons. And one of those reasons is Social Security, because the amount of taxable income that you have can impact how much of your Social Security winds up becoming taxable income. And if some of you are thinking, Mel, what do you mean? I get taxed on my Social Security? Well, kinda, and some people kind of a lot. So here's how this works. Let's say Mary is single. So follow the lower box. If Mary's provisional income, modified adjusted gross income, and there's a whole formula for how this works. If Mary's provisional income, taxable income, is above $34,000, up to 85% of her Social Security benefit can then be counted as taxable income. I'll say that again. If Mary's taxable income is above 34,000, then 85% of Mary's Social Security benefit can then become counted as taxable income. If Mary is married and between her and her spouse, their taxable income is above $44,000, which is not hard to do, up to 85% of their combined Social Security benefit can then be counted as taxable income. So here's how that plays out for Mary. Let's say Mary's taxable income is $40,000. Mary's Social Security benefit is about $26,000. Well, that's above 34, so 85% of Mary's Social Security benefit is $22,100. We have to now add that in to Mary's taxable income, which now becomes, instead of that 40,000, it's now 62,100. Mary was in the 12% tax bracket when she was at 40,000. She is now in the 22% tax bracket and well into it at 62,100. This is how taxable income, once you meet Social Security and the rest of taxable income in retirement, can really impact taxes later on down the road. Yep, that's how they get ya. So when we're looking at RMDs and things like that, we really want to be strategic. Some folks, it doesn't matter and it's not going to make a big difference. But for others, we want to be watching drawdown strategies and things of that nature, because maybe that 13,000 wouldn't make a difference, but maybe half of that wouldn't tip somebody into another tax bracket, and you can route the other half to charities and organizations, and that would. So it's not an all or nothing. You can route portions of RMDs. So that's why qualified charitable distributions are just a really good strategy to know in general for anybody who has IRAs. And folks, this is not just for people in their 70s. This is for people who are also going to be inheriting IRAs. After the end of 2019, they did something called the elimination of the stretch IRA, meaning if you are not a spouse, and there's a few other considerations, but for the most part, if you are children, especially nieces, nephews, and you inherit an IRA, you cannot stretch those distributions across your lifetime any longer, which means children and other family members, you have to now drain the entirety of those accounts within 10 years. IRS and Uncle Sam wants to collect that tax revenue off of these accounts. So what that looks like is this. Let's say Jake has a dad passes away, leaves Jake the IRA. Under those new guidelines, Jake only has 10 years to take all of that money. Now, they don't care how you do this. You could take all of it in 1 year. I would never recommend that, but you can do it however you want, but a lot of the times we'll even distributions over the course of that 10 years. That's $25,000 that Jake now adds to his taxable income. Well, what if that 25,000 bumps him into another tax bracket? This is where qualified distributions can also be a really good strategy, and those QCDs can come in handy. So we want to pay attention to those tax brackets and taxable income coming in where it's something a little out of the ordinary or we're not used to. So QCDs, good to know for everybody. Next at bat, naming charitable organizations as beneficiaries. You can do that on IRAs. Another really good strategic place you can do that with is life insurance. So the easiest way to go about this is naming a charitable organization as a beneficiary on a life insurance policy. And you can do this as a certain percentage, 20% beneficiary. I just had a case a few months ago, somebody, their kids no longer needed the money. Like, my kids don't need this. What do I do with this? I asked the question, are you charitably inclined? Is there an organization that you would really like to support? Turns out there was. So some insurance companies require you to prove that you've donated to the charity in the past before you can name them as a beneficiary, while others have fewer requirements. But any proceeds that come from a life insurance policy are inherently tax-free. So that's just a really lovely, easy way to potentially support organizations that you care about. Another way that you can use life insurance, which is sort of lesser known, is you can transfer the ownership of a policy that you already have. And this is a way that you can receive a tax deduction. If you do it that way, you can actually get a tax deduction for the amount of the premiums that you have paid in. This is one of those strategies that works only if you happen to itemize. They really moved away from strategies that we used to be able to get, but now with the standard deduction the way it is, a lot of these strategies is only for folks who itemize up to 50% of your AGI, but that is a way. Gifting dividends, this is only for people who have policies that are variable life, variable annuities. You can actually gift your dividends in those policies and receive a tax deduction for it. So if you happen to have those policies, talk to your agents, talk to your advisors, and see if that's something that could potentially be a strategy that you can employ. But there are a few things that you can do with life insurance. Other types of assets. Again, we're going over things that you do not have to dip into bank accounts. Crypto. MTF is going to be set up to be able to accept crypto. Non-cash assets. Cars. Have an old car, or my goodness, if a family, there's an estate and you're like, I don't know what to do with this, you can gift cars. You can get a tax deduction for the fair market value, as in what it's worth today, for any car that you donate. Unfortunately, only if you itemize, but it is there. Real estate, you can take an income tax deduction, again, fair market value. It can be up to 30% of your adjusted gross income. The whole point is there are so many other kinds of gifts other than the Scrooge McDuck swimming through the gold. Lots of things that you can do. One thing I also wanted to touch on very quickly are donor advised funds. They're called DAFs. We hear them a lot in the planned giving space, and this can be very, very strategic philanthropy. So these are charitable investment accounts for the sole purpose of supporting charitable organizations. These kind of funds are maintained by another 501c3 in the town I live in. It's called the Community Foundation is big on this. So how they work is a donor will give cash or any other kind of assets to a donor advised funds. You get to receive a tax deduction immediately for your gift. That gift, if it's a non-cash asset, they'll liquidate it. That cash goes into an investment account where it grows over time. And then you, as the donor, at a time later on down the road, get to say, hi, donor here. I would like to now designate my gift to the charity of my choosing. Now, that can be a one-time gift, or it can be a recurring gift. And you get to decide what that is. If it is for a grant, you get to decide what that grant is designated for. So it's very strategic philanthropy. There are those great tax benefits, and there's a lot of flexibility in the charitable giving with those donor advised funds. So those are a little Cliff's Notes version about how DAFs work if they ever come up. So, as always, everybody, when it comes to any of these strategies, always best to consult your financial advisor and your tax advisor to see what's appropriate for you and your tax situation. And somewhere, Eli, my compliance officer can take a breath and his blood pressure can come down, because that's it. We are done. So planned giving, everybody, is just that. It has to be planned. Talk to your advisors regarding any of these strategies to see if they can be a fit for you and your households. And if you would like to continue the discussion, I'd be more than happy to speak to anyone, especially folks a part of this webinar. As Adrienne said earlier, this is an organization near and dear to me. I offer no cost, no obligation reviews to anybody who is here this evening. So thank you so much for hanging in there with me. I hope no one has elected to chew glass as a result of all the tax talk. And now we'd like to open the floor if anybody has any questions.
Yeah, anybody have any questions for Mel at this point? I think you answered most of mine in the presentation, so which was, you know, partial donations of the pieces that yeah, capital gains and things of that nature. So yeah, that's thanks for being so thorough, Mel. All right. Not not hearing any questions. If somebody, let me ask you this question, Mel. If somebody had they didn't know kind of like where to start, right? So they realized, maybe they weren't saving in the beginning, and now, they're like, I got to get my butt in gear and really start strategizing about my future in retirement. What do you recommend is the first step?
First step is track, do an analysis of household expenses versus it's what's incoming versus what's outgoing. That's the biggest piece of advice I can give.
And is that something that you offer when you do a review?
Yeah. Oh,
Cool.
that is absolutely a part of the review.
Cool.
When I first meet with folks, that is what I will have somebody do. We've got to take a look at what's incoming versus outgoing, just like you would a business. That's how it works for individual as well, because then we have to take a look and see, like, okay, if we're talking about saving for what I say, working on your own terms, then how much are we able to save? And then it's the conversation about where is best to direct that saving. But if we don't have that number, then it's really, really hard to plan. And that would be the first step. So tracking expenses, see what's coming in versus what's going out. And then there's a lot of other strategies for business owners as well.
Maybe we could have you back, or I know we had talked about doing a webinar series with you as well, and maybe that business owner piece is going to be appealing for our audience as well. So
Oh, yeah.
yeah.
Business owners, I mean, what I always tell people is like, currently, who is in control about writing the tax laws and making the rules? Take a look at that demographic, and then, who are they working for? Um, business owners. So now that may be higher level corporate and things like that, but still business owners nonetheless. So that's who our tax code is written to privilege. Diplomatic way of saying that. So but yeah, so it's good to be able to know certain things and to be able to take advantage of how our tax laws are written.
For sure. For sure. Awesome. Any other questions? Thank you, Karen, for that the chat. I agree. All right. Well, thank you very much, Mel. Mel, this is the first of a few things that Mel is going to do with us, and we're going to be excited to have you back. So stay tuned for more insights. And as a reminder, you can visit massagetherapyfoundation.org to look at all of the programming we are doing, including we'll be at AMTA convention in Tampa in September. And the International Massage Therapy Research Conference is in Arlington next April. So we hope to see you there. We have a bunch of other cool things that are going to be happening in between those two. So thank you, Mel, so much for your time and generously donating your time. It was really, really informative.
Happy to be here.
All right. All right.
Okay.
All right. Thank you so much, everybody. Have a good night.